Well, greetings and salutations, test takers. This is the Series 7 Guru. I'm coming to you from my studio here in fabulous Las Vegas with another explication request. The best free supplement to your paid study materials is my YouTube channel, but if you don't have a Kaplan Q Bank, I highly recommend that. I'll help you with any questions, just easier if it's a Kaplan question like this, because you can just give me the QID 1264148 like this, and I can bring it up backstage, see what you're looking at. If you don't have a Kaplan Q Bank as a paid supplement, I recommend that with my Guru 15% discount code at checkout. You can get it for about $55, like $55.80 or something like that. It's the best Q Bank in its class. And for that commercial, Kaplan allows me to give you a free look on Kaplan content. So let's get busy on this one. Reggie owns a convertible bond that converts into 20 shares of common stock. Now, that's kind of nice because they told us that. You know, sometimes on your exam, you might have to figure out the conversion ratio. It may not be given information. In other words, they may have given you the conversion price of 50, and then you would have to establish that if you chose to, you could turn this bond in and get 20 shares of the common. All right, so that's important to us. The current market value of the bond that's important. So that's not its current price. That's what it closed at on Friday. So that's important. And the reason that's important is that clients get confused about this all the time. That's yesterday's news, right? Every day is a new day, right? A 30-day call is announced before the opening on Monday, April 4th. So over the weekend, they've announced that they're calling this bond at 102. And so we can get 1,020. Well, that's what we will receive if the bond gets called away from us. And so we need to figure out whether that price is going to be better than converting the bond. And so right now the stock is trading at 57.75. And so what we want to do is calculate parity. We want to figure out what would the bond be worth based on being able to turn it into 20 shares of the common stock. I don't know of any draw in your Series 7 in which you're not going to be asked to calculate either parity of the bond or parity of the stock. That means equal. You know, what is the equal price of the bond based on getting 20 shares of a stock at 57.75. All right, so let's do that. So we take the 20 shares, that's the conversion ratio. We times it by the current market price, 57.75, and we find out that the bond is worth $1,155. And that is certainly better than 1,020. So we should convert the bonds. We say, Reggie, what we should do is convert the bonds and get $1,155 worth of the stock. That is a better value proposition. By the way, not taxable when he does the conversion. You know, that's not a taxable event to convert your bond into the underlying common stock. All right. Again, I can't imagine any draw in which you're not going to have to either do parity of the bond or parity of the stock. If it was parity of the stock, we'd take the current market price of the bond and divide. And we could have approached it that way as well. We could have figured out what 1,020 means in terms of a stock price and found out that that's not the best way to go. So always on math, lots of ways to go. Remember, inch by inch, your Series 7 is a cinch, yard by yard, your Series 7 is hard, and I'll see you for the next explication request.